Good morning. Happy Thursday. This is Carrie Sparks with Pioneer Title, your go-to gal for title insurance and sales strategies. My phone number is 602-715-5704, and I just want to welcome you to Thursday. So far, it's been a great day. Today, we're going to be talking about reverse mortgage purchase money. We've got Paul Phoenix back talking about that. We're doing a series together. Our hope is that next week we'll talk about new construction, but with lending always changing, it's possible that the product won't exist. So, or maybe it will, but it'll depend on that call that Paul's going to be on today. But we're thankful, grateful to have you back, Paul. I know that after last week's recording, you had some issues. And I'm concerned about you. So I'm glad you're back. Patty Larson, who is your escrow officer at our Chandler office, we were very concerned about you, but I want to turn everything over. We're going to talk about how a realtor can help their customers if they qualify based on their age and all that kind of good stuff to possibly get into a home that maybe they hadn't considered in their price range. But take it from there, Paul.
Well, thank you, Carrie. And it's been a week and I'm home and safe and feeling incredibly good now. So yeah, that was a pretty scary time, but thanks again for you guys' concern. And, but yeah, we'll be talking today about actually using a reverse mortgage for a purchase. It's one of the best tools you can use as a realtor to increase your client's buying power, especially if they have to be 62 and above, but it's also a little bit, I don't want to say it's an easier loan to obtain for a client. It takes a lot of the stress out of the process. Last week, we went over like a general overview of how a reverse mortgage works. You asked me, the minimum lending limit on an FHA reverse mortgage is 62. There are some programs out there that go down to 60. But remember the age of the borrowers, the youngest age, if it's a couple, the youngest age directly tells them what their lending limit is, how much they can borrow using a reverse mortgage.
And if you're a married couple, only one has to qualify, right?
That's correct. Or a common law wife or husband, 7 years. And we went over that a little bit last week. If you have any questions, just give me a holler, shoot me an email or a text. And again, I didn't introduce myself. I'm Paul Phoenix with Next to Mortgage out of Chandler. I work all over the state though, especially Maricopa lately.
What's your license number?
My license, 176585 is my NMLS number. Yeah, I'm not missing any digits on it. I just got it early. So, but like I said, I'm based out of Chandler. If you have any questions, please reach out. It's phoenix@nextmortgage.com, or my phone number again is 480-734-7024.
So now we're going to just kind of walk us through. If I'm a realtor and I have somebody who qualifies based on age, talk to me about what you would, what tips do you
give a realtor
to start, just to kind of lay the groundwork for, maybe I would be originally shopping based on payment and how I can go lifestyle instead.
Correct. Saying down payment. If you've got, and a lot of times it's 62 and above, they're selling their primary residence. Let's use Minnesota, for example. They're going to come home with $250,000, come down with $250,000 in their pocket, or let's round numbers, $200,000 that they want to buy a house with. That's a very doable deal. In Maricopa, especially, average price around there is right around $200,000. And a lot of the agents I talk to, there's a lot of cash deals in Maricopa. You've seen it. But with a reverse mortgage, you can actually increase their buying power because of the lending limit. Now, if you don't mind, I'm going to go ahead and share a screen. What I'm going to do is show the actual, it's not letting me share. There we go. This is the actual loan application off what we use. It's called Reverse Vision. I've sort of filled out some bogus name in there, PJ Puff and stuff. Their mailing address, that would be their current address or the one that they just sold. And the next, if you look down here, the next thing is this is not a refi, it's a purchase. So let's say the purchase price is $200,000. That's how much money they have. That's what they found, and that's the equity that they use from their current property. Okay, so that would bring them down there. They'd be able to buy, but then they would, that cash, that equity be tied up.
And they
So
can be looking at any property type.
any property type. They can manufacture, condos, townhouses, correct. Everything is available. Anything an FHA loan will cover, this one will cover. On the next, then that's what we were just talking about, what kind of property it is. And again, if it's FHA, does it have a well? Is it on septic? Is a property in foreclosure? That is more important for a refinance. So it really doesn't go into this. And is it owner occupied? Now that's the thing, is it's got to be the primary residence. It can't be a second home. It can't be a vacation home. It has to be the primary residence. Okay. So with the purchase price of $200,000, and we put in a birth date right up here on the left-hand side of 6/2/1952, which should make them 67 years old. So what that does is it automatically calculates for us how much money that they would have to put down on that $200,000 house. And if this goes any slower, I wouldn't be surprised.
So the loan to value is based off of, correct me if I'm wrong, but based off the age of the customer, right?
That's correct. Loan to value.
If I'm 62 years old, I'm going to have to put more down than if I'm 80. And so based on amortization and life expectancy and all that kind of stuff is figured in algorithm background. Okay.
Right. And that's in a forward loan, it's called LTV, loan to value. Mm-hmm. In a reverse mortgage, it's called a lending limit. Okay. And this is based on a $200,000 house at 67 years old. Instead of putting all of their $200,000 down, they're only going to have to come in with $106,000, $106,288, the number in red here, which keeps them with $97,800 in equity, and the rest is paid for by the reverse mortgage. Again, they wouldn't have a payment, and they will always keep. I'm going to pull up a amortization schedule, and they'll always have equity in that home, no matter what. So they will always be able to leave something to their estate or to their family, their kids or grandkids. That house will never get upside down unless there's a catastrophic event with the market, which this has been overanalyzed. I don't think even if there was, anybody would lose. They would be upside down in these loans anymore. What I just pulled up here is what's called an amortization schedule. I'm going to go ahead and open this up, and this explains reverse mortgages pretty good. This is the house we just bought for $200,000. The initial principal limit, that's how much they lent on it. It was $102,200. Cash from buyer is $106,228. All right, on a $200,000 purchase price. Finance closing costs, that's your MIP, all your closing costs, a total, and this is an estimate, and I always estimate it high, of $8,428, which is about right. It's about 4%.
But closing costs on a reverse, they are traditionally higher than a forward mortgage.
They're an FHA loan. Yeah, they're a little bit higher. They're right at 4% instead of around the 2.5% to 3%. Yes. Okay. And now this is why it's important, because the expected appreciation, okay, and we're lowballing this at 4%. I've heard anywhere to 6 to 8% appreciation annually on a property. Okay, this is 4%. This is absolute worst case scenario. All right, so the beginning balance is $102,200, and the house is expected to appreciate 4% a year. So in the first year, the day you take over, the first year at age 68, your loan balance at the end of the year is going to be $106,959. The value has gone up to $208. That'll keep you with $101,000 in equity. All right. So let's jump ahead to 5 years old, or 5 years at 72 years old. The loan balance has gone up to $28,316. That's in 5 years. You've put $22,000 worth of interest on the backside of that loan, but your property value is gone up to $243,000, when your equity in your home is actually increased to $115,000. So an additional $14,000 in equity in that 5 years. And if you want to go another 10 years, it's 77 years old. The loan balance at that point is 161,100. It started at 106, so we're looking at $55,000 over 10 years. The property value is 296, and remember, this is 4% appreciation. It's low. You still have $134,942 equity in your home. Now, between 10 years, you've put $55,000 on your loan balance. Sounds like a lot, but that's 60 months of payments that you haven't made.
So let me ask you a question, Paul. How do you have it off the top of your head? Let's just say that they put that money into a forward mortgage back at the time of purchase.
What they owed.
How much would they have paid in payments during that period, and kind of do a compare and contrast, because this product is not for everybody, right?
No,
but it is for a lot, and it's not explored as often as maybe it should be.
Well, for example, and I'm going to run rough numbers on this, on a $100,000 loan. Well, for example, the loan balance has gone up 55,000. We all know that 10 years times 12, that's 120 payments they would have made. 120 payments. And for example, if you were making a full payment on the $100,000, it'd be about $800. They would have paid close to $96,000 in payments over those 10 years. They haven't had those payments. And if you look, you've only added, at 10 years, you've added $55,000 to the loan amount. So you're saving both ways. So if this was a forward mortgage, the difference would be you wouldn't have a higher balance. You would have paid $96,000 in interest. And if I had a forward amortization schedule, it would show you that the loan balance in 10 years I'd say it'd be roughly down to about $90,000. You'd have only paid about $20,000 in principal on that loan. Whereas this one, you've added $55,000 in principal, but you haven't made $90,000 in payments. So you win on both sides of that. Wow. If you can get your mind around that, it's instead of the loan balance on a forward, the loan balance would go down. But as you well know, all the interest on 30-year, especially FHAs, the majority of the principal is paid at the beginning of the loan. So you're paying very little on your equity for the first few years of a normal forward mortgage. That's why it feels like it's never getting paid off until about the 10-year level. That's when it really starts chunking away at principal. So this is where it really saves people is, in the first 10 years, you're only adding $55,000 to the balance of your loan. You're not making $90,000 in payments, and you still have equity in your home. You still have substantial amount of equity in your home.
My husband and I, we've talked about, we've kind of got a plan set up with our home, because we're making a 10-year commitment to our house in the valley here, and who knows what will happen after that. But we're guessing that the house that we're in now is probably not going to be the one that we'll want to retire in.
Correct.
So we've been doing things obviously to rehab it and stuff like that, with the intention of that when he gets to a point where he would like to retire, and or maybe I don't work as much as I do now, that we can take some of the financial burden off, and whatever city that's in, maybe it's here, continues to be here in Gilbert, but we can put ourselves in our financial, it'll be a financial decision, as well as lifestyle. It's
quality of life. It's quality of life is what it is. It gives you the ability to make a decision to substantially increase your quality of life, because that's one of the biggest stressors in anybody's life is their mortgage payment. So,
right. Well, that's what we've talked about. We've talked about so that he retires after, he's had a long career in engineering. He can go and enjoy his life and
right.
not be wondering what's going to happen in that world. And just,
well, in the days of old, you worked 30 years for a company, 30, 40 years, you paid off your home and you retired. You didn't have a house payment. Those days are gone, especially with the boomers coming along. We have over 10,000 people turning 62 years old every single day, over 10,000. No, I'd say 95% of them are not prepared for retirement. None of their houses are. Yeah, that happens. None of them are paid off. And that's why FHA is really focusing on this program. That's why it's called Use Your Home to Stay in Your Home. This is going to be invaluable, especially with the huge amount of people you hear about. The boomers are going to overwhelm the Social Security. They're going to overwhelm Medicaid and Medicare. They're going to, if they were forced to sell their homes, they would crater the economy. There would be too many houses on the market. And what purpose if they sell it to move into an apartment where they're going to have to pay rent as well? So this is an invaluable product. And it's a great tool for people that have already retired, that sold their home back in Minnesota, didn't have it paid off, but still have a big chunk of equity. They can come out here and have a home that they don't have a payment on.
What would you say to like the kids? I mean, this is something where people have to go through a like counseling type of. I mean,
right?
They don't just jump into this.
No,
they have
the
to
first
go through
step
a process
before I can even take an application. I usually sit down with them, or it's a very long phone call, and go through the entire proposal and how it works. And at that point, they get on the phone and schedule a counseling session with an FHA, with a HUD counselor. I believe it's anywhere from 20 to 40 minutes. And that counselor wants to make sure they understand the program thoroughly, and they want to make sure I've done my job. And they want to make sure that they understand it and it's a right fit for them. It's only then
that if they have a concerned family member or whatever, that family member could be invited to participate.
Absolutely.
In the call, right?
And you know what? I'll get on the phone. I want everybody involved at the table, because a lot of times the children don't realize what kind of dire situation it is. It's their parents. They've always taken care of, provided, and now they don't realize that they're in a part of their life that they need help.
So if I'm a realtor, and usually with most of the lenders that I work with, you can get a loan done, even with the volume going through, it's somewhere between 30 days to 45 days. What is the turnaround time from application to funding on a purchase typically? I mean, I wouldn't want to hold you to.
The best I've ever done, and thank Patty, actually the best Patty's ever done, is 15 days.
I think Patty Larson at our Chandler office.
Yes, she's
wonderful.
And you know what? When it comes to reverse mortgages, we have a lot of title companies out there that work with the lenders, and I won't use them. Patty's the one. She's definitely on top of it. I mean, that woman's amazing. But yeah, it's the same process, speed. Safety's sake, I asked for 30 days, but I've closed them in 11, 12, 14 days is the best.
So it's running parallel.
Absolutely.
To a forward mortgage then.
Yes.
Okay.
Actually a little faster because of we don't have the huge we didn't have the big spike in volume with the rate drops and stuff like that. So and it's all about relationships. And I don't get on my soapbox, but a speedy loan is all about a properly submitted application package. The old saying, garbage in, garbage out. I like to make sure my packages are 100% tight when they go in. I don't like those calls from processors and underwriters. I'd rather be on the golf course or something. So it's all, the speed, I think, is directly reflected on the loan officer.
So if a realtor or someone who's going through the process of looking into home options and, or really any option when it comes to a reverse, whether it's a refinance or purchase, if they want to get a hold of you, how do they get a hold of you with your licensing information again?
It's simple.
Sorry.
It's okay. Paul Phoenix.
I want to keep it legal.
Yes. It's phoenix@nexamortgage.com. My NMLS number is 176585. Yes. And my phone number is 480-734-7024. And I've had that taped on the side of my computer for about 2 years.
So we'll end it here. but our intention is to, Paul and I'll be in conversation, I'm sure today or tomorrow, about whether or not we can go into construction financing on reverse mortgages next week, and just kind of keep the conversation going, because this is a part of the market when it comes to the FICO scores and just all the unknown that is going on out there. This
Right.
may be an option. It may be definitely worth a conversation with you to just explore the options. And then you're licensed in Arizona as well as California, if I'm correct. Right?
California, actually, yes, I think so. I can't get a hold of anybody in MLS. So it was supposed to be active 6 weeks ago and it's not. So I was just literally on the phone yesterday, but yes, I'm licensed. I just don't know if I can originate right now.
And good old COVID-19. Yeah.
Oh, God.
So anyways, thanks for joining us. Again, I'm Carrie Sparks with Pioneer Title. I can be reached at 602-715-5704. If you do not have a relationship with anyone at Pioneer, I'd love to be that resource for you for sales, marketing, just whatever I can do to help you build your business and help guide you as we come out of this crazy pandemic time in our history. If you're not prepared to bounce back, let me please help and guide you with some of the background I have and the tools and resources to help you with that. So thank you so much. Have a great day. And we'll be back with Paul. We will be back one way or the other next Thursday. And we'll talk either about maybe real-time scenarios, or we'll talk about hopefully construction financing. So have a great day.